Okay, I think we're good to go. Hey everyone, welcome back to another webinar. Just as a means of a quick introduction, Carl O'Brien is my name, I'm co-founder of StoreHero, and alongside is my co-founder Thomas. Hey Thomas, how are
Hey
things?
guys, hope all is well.
From the other side of the pond compared to when maybe we did our last webinar, you're in a different co-working space at least.
Yeah, dialing in here from New York this afternoon, so looking forward to getting into this one.
Fantastic. Cool. Well, look, again, welcome to everyone. A few people filtering in. I know there'll be a ton of watching on the webinar recording as well. So looking forward to diving in here and running through some content around planning, tracking and scaling with kind of our new forecasting features within the StoreHero platform. A lot of eagerly waited stuff that we're excited to dive in. So we'll do just that. So maybe just to kind of set the scene a little bit, to give a little bit of a background, myself and Thomas's favorite picture here. So from my perspective, maybe just to kick things off, some background before we both started StoreHero just over 18 months ago. On my
More
side,
than that now at this stage.
yeah, it's been 18 months, about 12 months now. Um, from my background, I spent the guts of 8 years running a digital marketing agency, web design and digital marketing agency based in Dublin. We saw the ups and downs of e-commerce for a lot of that time, how it's became more and more difficult for businesses to grow between privacy changes, data tracking, and attribution issues, as well as kind of rising customer acquisition costs and variable costs that meant it was really difficult to actually get a handle on growth and actually to have a clear pathway to grow. It's really through that experience that the kind of StoreHero, from my side at least, came about. Maybe Thomas, you can add to that as well.
Yeah, similar to myself, not strictly on the agency side, but I had a couple of small brands. Myself, I grew up with the family e-commerce business at home and saw a lot of the challenges that we're trying to solve here at StoreHero during my time at Shopify as well. So originally worked at Shopify for about 3.5 years, originally with kind of smaller brands and then kind of worked into, I suppose, the bigger space of Shopify Plus brands, particularly in the UK. And funnily enough, like a lot of the challenges that we see with smaller merchants on the Store Hero platform are certainly challenges and issues and problems that the biggest brands on Shopify are all struggling with as well. People want to understand where's the best bang for their buck, are we profitable, and how are we going to move forward next quarter? And that's really what we're going to dive into today.
Definitely, it's really true, that kind of background where StoreHero came from, and I can give a bit of a brief kind of bit of context, I suppose, before we dive into the meat and potatoes of actual value tactical stuff that everyone can leave here today with. First and foremost, we'll actually kind of give a bit of broader context on a profit first methodology, what that actually means. We'll start to apply that into the kind of key principles of forecasting, how to approach forecasting for your e-commerce brand or maybe for your clients with that kind of profit-driven view, not just looking at that revenue component. From there, we'll actually spend the guts of our time today with a live demo of our forecasting tool within StoreHero to actually show how you can input your assumptions and build a reliable plan for growth, ultimately for the next kind of 12 months. And then finally, we'll also give a bit of a sneak peek on some of our new insights features to help not only kind of analyze that data and see how you're on track or off track, but ultimately let the platform do it for you. So again, as we kind of alluded to, StoreHero in short is and the profit platform and dashboard for growing e-commerce brands and also the agencies that they work with. So ultimately what StoreHero will do is not only sync all of your sales and marketing data in one place, but unlike other tools, will actually integrate those variable costs to know the true profit you're generating at a store, a product, or an order level. So we do that in 3 key ways. So first and foremost, it's the review element. One consolidated view to see your store in a different light than you usually have, to be honest. There's always some eye-opening moments or light bulb moments as part of that initial piece, because if you're just running your business through revenue metrics on a daily basis and maybe then maybe get a little bit of a shock to the system when you speak to the accountant at the end of the month, there's ultimately a disconnect there that the review part of the platform can really help solve. Now, ultimately, based on a lot of the stuff we're going to run through today, that doesn't tell the full picture either. Most analytics platforms are going to compare your current performance, albeit only a partial picture, but even without that profit kind of data. Got to compare that against previous period, previous month, previous year. But that doesn't necessarily line up with where we want to go as a business. So our planning tool allows us to develop a profit-driven plan to achieve our goals. And I won't over-explain that because I'll ruin the surprises. And then finally, we have the track elements. So from there, it's really putting those two elements together. We know what's happening on a day-to-day basis. We know where we want to go, and ultimately, how are we pacing against those goals? So really, to do so in a way that's practical, easy to use, rather than it being a burden to try to diagnose and understand what those kind of, what the data and analytics is actually telling me. We have a simple traffic light system to see where you're on track, off track versus those goals. Just maybe to set the scene a little bit, it's no surprise that profitability isn't guaranteed in e-commerce today through a ton of different variables, both variable costs and other variables within the business that make that very difficult. From analysing hundreds of stores over the last 2 years, we can see a couple of common trends, I suppose, not only indicate why brands leak profit, but also adversely why the profitable ones don't leak profit as well. First and foremost, they don't tend to have a clear view of future revenue. They're not ultimately building a seasonal plan, and we know we're not going to achieve our goal, whatever that almighty goal looks like on an annualized basis. We're not going to achieve it in 12 equal increments. We need to know and set reliable expectations as to what that looks like month on month. Secondly, customer acquisition costs can easily surprise us. And ultimately, if the trend consistently for us as a business and as an industry is incrementally increasing customer acquisition cost, we equally shouldn't be too surprised by it. We need to make sure we take that into account as part of our plan and look at the realities of our business. Do everything we can to improve that, but also not cross our fingers and close our eyes and hope for the best. We need to approach it with a better plan than that. Thirdly, resource misallocation. So inevitably, this is a really tough part of e-commerce, between stock, between cash, and ultimately, you're making a forward investment, you're making a future bet as to the outcome that you might expect, whether it's that forward purchase of inventory, making a choice to tie up cash or maybe draw down cash, and equally when to spend because you feel like you're going to get the return, but equally also not underspending and missing opportunities. There's a lot of bets that have to be made sometimes, and I suppose what we want to understand is, are they calculated? Are they done with the information we can potentially have at our disposal? And then ultimately, all time together, we want to make sure we're finding that balance between the clouds and the dirt. We want to be ambitious. We want to set a goal that's actually going to excite us about getting up in the morning and justify all the hard work that everyone in the e-commerce sector does. But we can't just leave it at that. We need to break it down and use the data to inform how we can reach that goal, or equally find a way to achieve our underlying priorities, whether it's profit, whatever the case may be, in the most kind of feasible way. It is very much choose your own adventure. There's plenty of ways to get to a potential path. If for example, a specific profit number at the end of the day, you'll have tons of different business models, varieties, levels of scale, levels of margin that can reach that same outcome. And it's ultimately, you need to choose, okay, what's the pathway you're going to take based on the destination you want to reach. Just to kind of give a quick example, and anyone who's been on our webinars before might have seen this, but I think it's a worthwhile illustration of kind of not only the levers that are at hand on a per order basis, but also as well the kind of challenges we've kind of seen on an industry level as well. Let's take a sample order. So let's say you have an average order value of $100. We can see here we're not left $100 by any stretch of the imagination. Between our product costs, packing, shipping, transaction fees, taxes, marketing spend, taxes, even variable costs, keeping at that for a second, all of these pieces obviously are going to take a big slice of the pie, literally. From there, we obviously have our marketing spend, the costs were ultimately taken into account to acquire a customer. And then finally, we have our profit. So in this case, we've $14 left over. After not only our variable costs, but after the cost of marketing. What you'll see within StoreHero as contribution margin, whether it's on a per order basis, a per customer basis, or actually a store level as well. Now, ultimately, if we're seeing that customer acquisition costs are incrementally increasing over time, this can easily happen. So we've gone from $25 to $35. I don't think anyone would be thinks I'd be too wild as a bet to make here that at 20 to 30% customer acquisition cost increase year on year isn't the craziest expectation to have. But what's happened there to profit is we've gone from nearly $15 to just under $5 of profit. Just for argument's sake, we now have to drive 3 times the volume of orders to maintain the same level of profit if we don't make any other changes. Ultimately, the key point here to indicate is it's not a case of, I suppose, ultimately just trying to spend our way out of this problem. Oftentimes, driving scale is actually the pathway to do so, but we need to do so more intelligently, because if we're not looking at these unit economics and just trying to do more things, this could actually be a painful pathway to reach that goal. It doesn't have to be that difficult. So just to kind of give some context on the profit first system, one thing that really stood out to me running the digital agency, solving these problems and running a bootstrap business myself, was I came across a book, Profit First by Mike Michalowicz. The conventional accounting standard here is that revenue minus costs equals profit. It's how you prepare your annual accounts for yourself by way of your accountant. It's how you submit to revenue to pay your tax. But it's not necessarily the best way to run your business. The reason for that is in this scenario, in this equation, profit is an afterthought. And as we know, things that are left as an afterthought, there's maybe not that much left of them at the end of the day. It's not a purposeful measured decision that we're making. It's an outcome rather than or an output rather than an input. So what would it look like if this were easy? To flip that on its head, what if we thought about our business and our planning and our forecasting in this way? Revenue minus profit equals costs. In this scenario, we're making profit a non-negotiable, and ultimately building a plan. Of course, it needs to be realistic, but what is the level of profit that actually justifies you running your business? And from there, once you understand what that is, you might it might be kind of higher or lower than the market demands. But at the end of the day, it gives you an indication of the cost structure you need in order to support those goals. Equally, if that doesn't match up, if you can't deliver that, you may need to relook at your expectations. But again, we haven't even got into it, and already you're having a much more measured, deep conversation and I suppose helpful conversation than, again, just looking at that profit as an outcome. Any e-commerce business and any business overall will see the kind of a profit and loss statement broken into a number of key cost centers. But we see these as kind of the 4 key dials of e-commerce finance, 4 elements that make up that pie chart that is your revenue that you need to account for. And as part of that kind of cost component that we just spoke about. So ultimately, one of them is going to be your variable costs. So that's going to, in a StoreHero context, how we try to think about that is your fully loaded variable costs: product, packing, shipping, transaction fees, discounts, returns, taxes, ad spend, taxes all taken into account. With that in mind, it's a true sense of what are the actual order level costs. As you drive more orders, you have more of them. I think the challenge a lot of brands make is they don't have clear visibility on this. They don't have the tools don't give them the capacity to see this very easily without actually doing a ton of work on spreadsheets, which can be quite cumbersome and tedious. But we want to truly know what's the order level cost that we fully take into account. From there, we naturally have our marketing cost. So again, in our context, we're looking at advertising spend, but any other kind of marketing related costs, whether it's agency fees, whether it's photo shoots, anything it's investing in order to kind of turn the dial to drive revenue off the back. If you feel spending more in that area should drive more outcome in terms of outputs, revenue, profit, then ultimately it might be something you consider as a marketing cost to fully appreciate the costs that then are taken into account that you might dial up and down. Thirdly, you'll have your operating costs. So that's going to be your staff and rent costs. From our perspective and our experience, I should say, that lands somewhere between 10 and 20% of revenue and net revenue for most businesses. The ones that are able to kind of run a lean, tight ship can keep that lower. So ultimately, the idea there is as you scale your business, those fixed costs can stay relatively consistent and stable. We don't necessarily have to add to them as much as maybe a variable cost will increase. And then finally, we have profit, which is a kind of 4th component as part of that dial. And again, it's nearly like a cost we want to account for here. with the expectation we want to, the old kind of Peter Drucker expression, what gets measured gets managed. If we take it into account now, we're in a better position that there's actually some of it left. So ultimately, as we look at these individual dials, the idea is whether it's our variable costs, our marketing costs, our operating expenses, or our profit, as we increase one, we kind of maybe reduce the space left for the others. And we need to understand, okay, what are the dials we can and need to change in order to give us the best outcome? For example, that variable cost dial, we might try to improve that, get our order level cost down by maybe reassessing when we give free shipping and when we don't. When is it actually worth our while? Is it additive to the business? It might be a nice incentive to drive more orders, but it's actually helping drive more profitable orders, or orders at a profit we need to maintain based on our goals. From there, we might look at optimizing our marketing costs. We might look to invest in marketing and dial up that dial, or dial it down by making better use of that spend with maybe better creatives, for example. Thirdly, we might want to look at the kind of operating expense dial. As I mentioned there, if most of the time people will look to kind of see their fixed costs, they may be relatively similar on an absolute kind of dollar, euro, pound basis, but as they scale up the business, they represent a smaller slice of that pie. So again, more slices of pie left to cover the other levers and dials. And then finally, you have that profit piece. So ultimately, again, in this case, if you have kind of a higher or lower profit expectation, if you want to redrive profit, something's got to give in order to make sure this all fits in within your pie chart. Are you going to do so by making better use of your marketing costs, by reducing your operating expenses? Maybe it's, again, negotiating those cost of goods, and you're setting yourself up for success and giving a bigger slice of that pie left for profit as well. So before we dive into the actual forecast building, just to give some broader context as to how we use these. So we now know we want to think profit first. We don't want profit to be an afterthought. We want to understand what's the level of profit expectation that we need to build into our plan in order to make sure there's some of it left over. We understand the core dials of the business. Whenever we're driving revenue and setting forecasts, what are the things we need to account for, whether it's marketing costs, fixed costs, operating expenses, and obviously our variable costs from there. So from here, we can actually start to take those kind of core assumptions and build them into a plan. So first, we're going to set our sales and profit priorities. So ultimately, we need to know what the destination is going to look like and what we want it to be. So ultimately, rather than just setting that top line sales goal, maybe you're looking to get from 6 to 7 figures, or maybe you're looking to get from 7 to 8 or 8 to 9 figures. We've brands on across 15 countries. Everyone is going to fall into somewhere within that range. Ultimately, you might want to say, we want to dial up sales and maintain our profit margin, or equally, we're happy to even do less sales with a higher profit. There's so many variables on that we can input. From there, then we can set some assumptions based on past performance. So especially when we come into look at those kind of key dials, we're not starting from scratch as to what we expect our variable cost to be, our operating expenses to be. We have some past data to use as a reference point. It's obviously a common adage whenever you see one of those kind of financial services ads where there's a disclaimer at the end that says past performance does not indicate future performance, or whatever it is. I would disagree. It might not predict it, but it's certainly a good indication. And ultimately, more often than not, the kind of past can give us a clear indication, or at least a better indication of the future in some cases. So with the way we look at it is ignore it at your peril. Take it into account unless you have a good reason why you shouldn't. Thirdly, what we'll do is we'll actually break our goals into seasonally adjusted month-on-month targets. So we've set our sales profit priorities, we've set our assumptions. As I said earlier, we're not going to achieve our goals in 12 equal parts. So we need to understand what each month is going to represent as responsibility in order to achieve that goal. And once we can fit that in, now finally we can actually start to track our performance daily versus those expectations that we've set. So before we dive in, one caveat to remember, some people often get tied up as part of this exercise in general, in the forecasting space. Definitely, if you're doing it through spreadsheets, with creating the perfect plan, we are trying to predict the future with that crystal ball. In reality, that's not realistic. There's going to be variables, for all the reasons why StoreHero exists. There's so many different variable components within your business that it's hard to predict every individual element. And a forecast won't do that. And it's not valuable if it's only doing that. The forecast is aimed to give a clear roadmap on what are the kind of key kind of guardrails on the bowling alley lane, keeping you in the lines as to, okay, where are we on track, where are we off track, and therefore where do we need to kind of make adjustments, and where do we need to kind of make better decisions. Now, I'll also actually to counter the point I've just made, but even though it doesn't always line up, this plan that we've used has helped dozens of 7- and 6-figure businesses as well scale dramatically. Double-digit percentage increases, triple-digit percentage increases in sales year on year, and actually their actual values line up very, very closely to this target because of the assumptions we're making. Doesn't always happen, but it certainly can. And again, that's the value you can kind of get from this. So we want to go from a position where we simply say a statement like, okay, we want to achieve a specific 4.2 ROAS. That's not the intention. We don't want to predict your ROAS in isolation. We want to help you understand what are the upper limits as to when you can scale spend and when you need to pull back. Alternatively, we want to have a deeper conversation than just saying, okay, we're off track on sales. That doesn't give us much to work with. If we're in a much better, if we kind of ask a better question, we're in a position to get a better answer. If we can ask, well, why are we off sales? Well, because new customer sales are off. We're also behind on our marketing spend, and maybe average order value is off. These are much more precise problems to solve and things that the forecast will do. So from there, I'll pass it over to yourself, Thomas, to dive in and put this all into practice.
Perfect. Thanks very, very much for everyone for jumping on this evening. Hope you can all see my screen there in front of you. Just before we kind of dive in to set the scene, I suppose, why do we build this? Really interesting. So from our perspective, a lot of the feedback that we got over the last 2 years is that, we want to make the data within StoreHero more actionable. Obviously, the nature of any analytics or reporting tool that anybody's going to use within their business, purely derives from their ability to make better decisions based on the data that's in there. Some of the feedback was that without a map or a plan as to what each number should be delivering, it was making it a little bit more tricky for brands to make better decisions. The second and deeper problem within that was we actually uncovered that a lot of brands were struggling to make the plan effectively. The forecast was often being passed over from finance people or from founders, or maybe it was just very, very top line. We have a plan to hit 4 million this year, 5, 6, 7, whatever it's going to be. And that marketing was an afterthought. How many new customers we needed each month was an afterthought. We didn't understand why we needed to understand how our operating expenses could dictate how much we could afford to spend from a marketing perspective. And it was just difficult to marry the e-commerce team, the marketing, either paid media head or the agency, along with the finance team, and just trying to get everybody on one page. Much more difficult than it might immediately seem. So that's kind of first and foremost. We want to help brands set the scene, help them understand their business and how it all really knits together to kind of answer the million-dollar question, how much can we afford to spend on marketing, which is getting increasingly more difficult by the hour, I think, as we can probably all agree on this webinar. So just to set the scene, we're going to go through some of the same stuff here that Carl kind of touched on, but just with a more tangible example directly on the StoreHero platform. Again, anybody who has a StoreHero account can access this. And if you have any questions, feel free to drop them in the chat or ping us an email directly. So let's just say, we want to hit an annual revenue target of 1.4 million. So we can see here, 1.4 million represents the full pie. So all of our costs need to fit into this circle along with our profitability. So 1.4 million is the full pie. Next up, we have our fully loaded cost of goods. So what's in there? It's our product fees, obviously from Shopify. It's our packing costs to get the orders packed. It's our shipping costs to get the product to the customer, transaction fees, irrespective of whether it's a Klarna, buy now later pay solution, Shopify payments, PayPal, whatever it's going to be. Any returns costs, any of you running apparel brands will be dealing with a lot of returns. So all of those costs are fully baked in here. So we know if we're going to run a 1.4 million year, at 40% COGS, it's obviously going to cost us 40% of that to get those orders to the customer. Therefore, 560K is gone straight away. Then we have our operating expenses. So we can see these here. So we're estimating that for the business doing 1.4 million this year, our operating expenses are 210K to run the business. That's our staff costs. It's our labor. It's our rent costs, light, heat, electricity. Cost to keep the lights on, essentially. We'll come back to why that's important and why it feeds into the marketing equation in a second. So that's in there. Then, most importantly, we want to be thinking profit first. Again, that's the whole foundation in which StoreHero is built on. We want people to make more profit for their businesses. So thinking about the forecast, we really want to think with the end in sight. What kind of profitability do you want from your business? And you should be thinking about this almost as a bill that you need to pay yourself at the end of the year, and then trying to work your marketing in behind it. So let's just revisit the circle. So we have 1.4 million. That's the full pie for the year. We have 560K is gone for our cost of goods. We've 210K of operating expenses to keep the lights on. We've also then treated profit as a bill that we need to pay ourselves, another 210K. So essentially, if we're to get square the circle, I suppose, to use the phrase, what's left over here? It's our full marketing budget. That's what's going to get us there. So we need to understand, that's our full revenue. That's what it's going to cost us to get the product out the door, cost to keep the lights on, profitability, marketing spend. It doesn't need to be a whole lot more complex than this. And then we have our splits of new and repeat customers. So, scaling brands may have a higher percentage into their new customer splits if they're really trying to grow up next year or scale heavier. But this is just kind of pulling an average of the last 12 months. So down the bottom here, what it's going to show us is very, very similar, exact same number there. But based on the metrics above, your business, you can afford to spend 419K as long as you maintain an average MER, marketing efficiency ratio, for those of you who aren't familiar with that acronym. So essentially net sales divided by full marketing spend. Just to give a quick explainer for anybody who is not familiar with that. ROAS, channel attributed ROAS, fantastic for channel level and even campaign level performance. But on a business level, we all have attribution issues. We all have, different types of marketing measurement issues. So MER is just broad strokes, net revenue divided by full marketing spend. So if we can spend 419K and achieve a marketing efficiency ratio at 3.34, we're going to land back at the 1.4 million revenue, and then everything works. We've hit our profit targets, we've covered our COGS, we've hit our operating expenses, and we've done it on the budget that we wanted to. And what StoreHero will show us is based on this, it looks to be a pretty reasonable expectation, because last year we did an MER of 6.09, so it looks to be a pretty reasonable goal. This piece is crucial. We can't just turn around and say, we do 1.4 million, I want to hit 500K of profit next year. While that will be fantastic, it's based on past performance. It's going to be a difficult thing to achieve. I'm just going to go ahead and pop that back to 210K for a quick second. Now, there's a couple of different levers that we have at our disposal, and I'm going to particularly talk about these two. And people often don't think about them as being crucially important when it comes to marketing spend. And why are they important? Our revenue target is going to be the exact same in the two scenarios I'm going to run through here, and our profit target is going to be the same. So we're going to hit the same top and bottom line goals for the business. But there's there's things that we can do from a COGS perspective / gross margin perspective, and also from an operating expense perspective, that will ultimately free up more budget and allow us to spend more money and even be less efficient, but still hit our target, both on the top line revenue side and on the profitability side. So let's just say, for instance, we were able to reduce our operating costs from 210K down to 180K. So we're going to save about 30K. What's going to happen here is when I reduce the operating expenses, we have much more room to play with now from a marketing perspective. This is going to get a little bit smaller. And therefore, what you're going to see happen here once I enter this is it's going to allow us to spend that extra 30K. And therefore, our efficiency does actually not need to be that much more. It's actually going to be, we can be a lot less efficient because we don't have as much cost to cover. So I'm just going to go ahead and change this to 180K. Okay, great. Now we have even more budget to free up to hit the exact same revenue target and the exact same profit margin target. So really what this underscores is the importance for brands to make sure that their operating expenses are being kept lean. Every dollar that we save, every pound, euro, whatever it is that we can save from an operating expense perspective directly flows into profitability or into increased budget that we can afford to spend in order to hit the exact same goals. So again, we've dropped the operating expense target from 180K, from 210 down to 180. That 30K has now gone directly to marketing. We can afford to spend a lot more on marketing, and it's gone from a 3.3 MER down to a 3.1. Therefore, we have just much more room to push. We can be a little bit freer on our marketing budget. We're hitting the exact same profitability target and the same top line revenue target. Now, I want to play the exact same scenario out on the COGS side of things. Sorry, not 2.1 million. That would be a disaster. On the COGS side of things. So just to kind of get into COGS. So obviously we have our discounts in there, our refunds, taxes, product packing, shipping, returns, all that kind of thing. This is often the biggest area of like easy opportunity. Like we come across a lot of brands who are doing a hell of a lot of discounting. Free shipping is like, 20% even below the average order value. They could be giving out free returns to everybody. Maybe they haven't thought about a price increase, even though their own COGS may have increased over the past couple of years. So there's a number of different ways that we can skin this. And if we can reduce our cost of goods, that's automatically going to improve or increase our gross profit margin. So let's just say, we could figure out a way to get our COGS from 40 to 35. What's going to happen here is once I put this in, this is going to get a bit lower. And therefore, what's going to happen is the extra budget from here is going to flow across to our marketing budget. We're going to have a lot more budget to spend. Again, we won't need to be as efficient. Okay, wow, that's a pretty big difference. So we've been able to spend an extra, 60, 70K, and we're down to an MER of 2.86. That's a hell of a lot more. We've way more budget to free up now. Alternatively, you could say we can get our COGS down. We don't think we're going to need to spend all of that money to get there. We don't want to just save on COGS and plow it all into marketing to hit the exact same figures. You can say, okay, we're going to get down to we're going to get our COGS down. We don't think we're going to need a whole lot more budget to spend. So what happens there? It directly flows into profitability. So we can say, maybe we're going to go for a higher profitability target. Again, we're back up to the 3.1. We're back down around the same marketing budget. We've just been able to improve our cost of goods, whether it's through less discounting, improved our return strategy, different offer structures, whatever it's going to be. There's loads of different ways that we can skin this. More so just to underscore the point that, revenue and top line revenue, bottom line revenue, super important. But from a COGS and operating perspective, there's so many little knock-on effects that this can have that can massively impact how much we can afford to spend and also how efficient we need to be in order to drive this. So let's just say we settled on this. This is what we want to hit next year. We've settled on our targets. We have our top line revenue figures. We know our OPEX. We now know we're going for about $250,000 in net profit margin for the year. We fully have our budgets mapped out and we know we need to do 3.11 of an MER in order to make this all work. What's going to happen next? Okay, we've settled on this. We've now looked at, it's automatically created as a full forecast for the year ahead. And to Carl's point earlier, we can't just take the 1.4 million target and divide it by 12. There's always going to be 2 to 3 core peaks throughout the year. For this business, we can see it kind of happens in April and May. And not dissimilar to probably every other e-commerce business on this webinar, there's going to be a big peak around November and December. Obviously, this will be different. Some furniture, outdoor brands will have their peak in summer, and every business is slightly different. But broad strokes, this is typically the flow that we would see. So in order for us to kind of properly map out a forecast for next year, we want to take that 1.4 million. And what we can see up here is these percentages. What do they represent? It represents last year's seasonality. So we want to use the new forecast that we set along with last year's seasonality in order to map out this year's forecast. So, last year we did 4.82 of our total revenue for the year in January. Assuming our product and marketing calendar looks pretty similar, we can anticipate that we're probably going to do roughly about that percentage of the 1.4 million this year. So we have our total revenue target for January is at 67K. Last year's average order value is about 47.80. So we need to use that to dictate how many things like orders we're going to need. So we can afford, based on the targets that we've now set, which include our operating expenses, our profit goal, we can afford to spend about 21K in order to get there. We need 18K of profitability after marketing spend, contribution margin, in order to get there. And we have operating expenses of about 17.5K, leaving us with a net profit margin in January of about $1,200. Again, this scales up and down at different times of the year, depending on seasonality, with the lion's share happening at the end of the year. Marketing efficiency ratio is all mapped out. We can see our full splits of how many new and repeat customers we need, our orders, gross profits per new and repeat customer, all the way down to things like how much can we afford to pay for a new customer, what revenue do we need to drive from Klaviyo, and this is all mapped out for every month of the year. The big benefit of this is that we're getting away from simply just having a financial forecast that was passed over from the financial director, the accounting team, whatever it's going to be. Now we have something that is more tangibly able to be used by the e-commerce and the marketing teams, because it's not just top and bottom line revenue. We have it broken out into how many exact orders do we need to drive? What revenue do we need from new customers, repeat customers? And the reason this is super useful is, I'm going to quickly jump on and finish this now. The reason that's super useful is, instead of having that just there, now we have all of the data in StoreHero, and going back to the original point of making the data much more actionable and easy to use, instead of logging into StoreHero now and needing to do your own interpretation to understand, is this good? Is this bad? We simply hit this little hamburger menu here. And what we can see is, what we've done this period versus last period. So we're up 16%. You might think fantastic. However, based on seasonality, the target for this time of the month was about 50K. So yeah, we're up 16%, but we should have actually been higher. So we've missed our revenue target so far this month by 6%. Not the end of the world though. We've had a marketing efficiency ratio of 9.49, which is up massively on last month, but way ahead of our target. We were only supposed to be at an MER of 3.11. And we can see our contribution profit as a result is up tremendously. So that's mainly as a result. We haven't spent a color of the budget that we had planned to spend. So we've spent about 5K, call it. Last month we'd spent 5.6, but we had actually been allowed, based on the targets that we just set ourselves, to spend about 16K this month. So it's no wonder that we've missed our revenue target. Of course, we have hit our profitability target, but it just really helps, I suppose, realign both e-com, marketing, and finance teams, founders, agencies, all under one roof, in order to get a real firm look at where are we falling on track, where are we off track, and again, really kind of making the platform much more actions driven. We now know very, very quickly the reason we didn't hit our sales budget is because we didn't spend the budget. But we can kind of get further down here. Every number now has a kind of a target set against it, so we can see new and repeat customer sales are behind, more new customer sales behind than repeat customers. But it just, again, kind of puts everything in perspective. We can quickly make targets for every number on the platform. And again, just really makes the tool much easier to understand and really much easier to make decisions on. Just going back to the first screen here, which we kind of land on, the spend advisor. So again, your 4 key numbers that you have for any e-com brand are your net sales, your total marketing budget, your marketing efficiency ratio, and that contribution margin target. So even though, again, revenue is up 16%, we've spent less money to get there, profitability is up tremendously. And we also have our targets, where we are versus target, beside each one of them as well. So just really, really interesting to be able to have all of that data at our fingertips and really be able to quickly diagnose with 20 or 30 different data points, where are we over executing, where are we falling down. Where we see people get the most value from this is, you may get to, where are we now, 14th of May. We look back at April, some brands will say, April was a great month, April was a terrible month, whatever it's going to be. But for a lot of people, if it's a terrible month, they just write it off as a bad month. And we don't actually have where are the diamonds in the rough for that month. Okay, maybe it was a bad month, but maybe we over executed from a Klaviyo perspective. Maybe we had way more new customers than we thought we would. Maybe on the flip side, we have a great month, but when we dig into it, we're actually massively over indexing on repeat customers and our new customer targets are way off. That's also a challenge. Even though you could be hitting your top line revenue targets and your profitability targets, if you're over relying or over indexing on repeat customers without knowing it, you're going to feel that 6-12 months down the line when you're not, actively replenishing your new customer funnel maybe as much as you should be. Pass back to yourself, Carl.
Thanks very much, Thomas. Question in there from Sonia. So do you recommend setting your MER target? So I presume this is in the first step in the forecast builder at a similar level to last year, higher or lower? So looking to understand how ambitious we should kind of be, and presume balancing ambition with realism there as well.
Yeah, I mean, this is probably the biggest question we always get. Like, what should my MER target be? And it's a very reasonable question to ask. It's very hard to tell a brand straight away exactly what their MER target should be. Like, it depends. To answer your question, Svenja, it depends on what performances looks like and really what kind of revenue growth we're going for. If we're looking to maintain plus or minus 5 or 10%, you're probably going to be looking at a relatively similar MER for next year than you were last year, for instance. However, if you'd had a really good year last year and you guys are looking to scale from 1 to 3 million, in all earnest, you can't expect to have the same level of marketing efficiency ratio if you're chasing down much higher volume of sales, because as we all know, the more money you put into Meta and Google, you're not going to maintain the same levels of efficiency as you scale. So it really depends on the growth ambitions of the business, if there's been any fundamental cost structure changes within the business, or if your cogs have changed. Like for instance, you may have had a big change with your suppliers and you've freed up an awful lot of margin. Therefore, you could actually scale a hell of a lot higher with a much lower MER without sacrificing any profitability. It's a hard answer to give, but it really depends on the growth ambitions of the business, fused with any structurally kind of cost structure changes that may have occurred.
Just even to add to that, I completely agree. I think one thing I would always recommend brands look at is, okay, well, if you're again looking to scale dramatically, to whatever extent, if you're looking at your Emmy or last year, it would take a long hard look and see, okay, if left unattended, your return on your marketing will tend to fall. It won't be as efficient as it will be year on year. And if you're spending more, Meta and Google are going to have a harder job to try to put that budget to good use. It really comes down to what the realities of your business look like. If you've instituted a new agency who's performing really well, if you've been able to really up the ante when it comes to your creatives, these are all kind of logical data points as to why you think you'll get a better return on your marketing. Don't fall into the trap by just thinking, okay, if you've changed nothing, I would assume by default that your MER will be lower, unless you have a good reason as to why it won't. So yeah, as Thomas mentioned, very case by case specific, but definitely something that I suppose over time, you'll be able to get a sense of and kind of play around with. Ultimately, month on month as you go, it'll kind of give you a good indication there as well.
If you're in an agency as well, I wouldn't be afraid to challenge a brand as to where the efficiency target has come from, because a lot of the time we've just seen that it can be fabricated, or it can be based on channel attributed ROAS as opposed to overarching MER. So it's helpful to even go through the exercise that we have just gone through directly with clients, get them to figure out what their sales targets are, ask them what their profitability target is. People love being asked that question. And you're only asking for operating expenses on an average basis, more so to indicate how much can we actually afford to spend. The amount of times that we run through this exercise with businesses and there's actually way more budget to spend than they had actually previously anticipated or understood is honestly incredible. We've come across it so much, and we've seen some really, really good examples of brands all over the world that have used this to really drive a hell of a lot more spend without sacrificing any profitability, which is obviously the most important piece of the puzzle.
100%. Yeah, we've seen it time and time again. It's obviously, I'm sure, as everyone can expect, one benefit we're getting now over the last 2 years is a structured set of data, not only for each individual brand owner and agency to see their store or their client store in a new way, but ultimately spotting those patterns across all stores with a similar data set. We can ultimately see how that's kind of stacking over time, which obviously really helps. Cool. So just before we finish up, and again, thanks, Fenia. Please do drop any other questions in the chat, or for anyone watching on the recording, feel free to drop any queries in the live chat button within the StoreHero dashboard, or get in touch directly through whatever channel makes sense. I also want to give a bit of a sneak peek on some of the new features we have launching over the next couple of weeks. So goals and forecasting is live straight away. If you sign up for the free trial to StoreHero or get access within your account under settings and goals, you'll be able to start to get access to this and generate your forecast just as Thomas did in the same place in the live chat. Be more than happy to walk people through and actually kind of show them exactly how to do that and give some guidance on that as well. Now, ultimately, very much in line with the reasons why we introduced forecasting, our consistent goal is actually to help businesses generate and kind of take more value, extract more value from the StoreHero platform. Even if we launch no other new reports, there's so much value in there and so many insights that it's really a case of kind of finding the diamonds in the rough and bringing and elevate that data to people as much as possible. Seeing that traffic light system whereby people are on track and off track is obviously a massive benefit and a tool in order to facilitate that. But our new features around insights will even take it a step further. So just to kind of give a bit of an indication on exactly how this works, I can kind of share my screen and walk through it. So for any StoreHero customers on the call or on the webinar in the next couple of weeks, again, as I said, feel free to get in touch with us to enable this if you'd like early access. What you'll now start to see is an insight section on the dashboard. So just in the exact same format that Thomas just ran through there, the insight section really is built on the top of 6 key pillars. So ultimately what we're trying to do is distill your business into a number of key pillars that ultimately represent different goals and priorities in order to solve for that overall revenue and profit piece. So at the moment, and again, these are things we will kind of expand, those pillars are going to be your overall sales, your overall profit, your new customer sales, your new customer profit, your repeat customer sales, your repeat customer profit, as well as your marketing performance. And you can think of these as like mini insights or mini analysts that are going on with a specific job to do, that are analyzing your store data for a specific function. To make sure your new customers are growing and sales are growing, making sure they're profitable, making sure your overall sales is profitable, making sure your marketing is performing well. So first and foremost, you'll actually see what's working, what could be improved. If you have goals set, it'll be based on your goals. If not, it will actually take into account your past performance, previous period, previous year, stuff like that. Now, where this gets really interesting is when you actually start to hit explore and review and look at these insights in a deeper way. Ultimately, what these insights cards and kind of mini analysts and insights agents will do is start to break down what's happening, why it's happening, and ultimately what to do about it. So it's the equivalent of having an e-commerce advisor or an e-commerce consultant 24/7 available to you to start to help you interpret your data and make better profit-driven decisions. So let's say, again, one of our key pillars is going to be driving new customer sales. Well, we want to grow overall sales and profit. We want to think about the sustainability of the business. Part of that is driving new customer sales. We can see here, okay, new customer sales is 10% behind target. We can start to understand what was affecting that. Okay, so we had less new customers, and that's going to affect our ability to drive sales from new customers, but also the customers that did come, they actually spent less. We can see here how we're tracking against the previous period, previous year, and versus target. And between those, what StoreHero will do is look at that overarching metric and then jump into a ton of underlying data points. Secondary metrics are things that might affect new customer sales in order to distill why. So here it'll come back with an automated likely cause paragraph to understand why that change is happening. So in this case, it's saying new customer sales are behind target. Why? Mainly due to underspending, despite good efficiency and order quality. So again, equally, sometimes this might come back and say, we're actually spending your budget, but maybe your budget actually isn't returning the level of sales that your budget isn't being utilized as well. Maybe it's going towards ads that aren't performing. In this case, we're actually just not using our budget. So new customer sales are below the target. Again, we've only spent 4K out of the 16K. So only 31% of the planned budget was spent. New customer count is okay, indicating good acquisition efficiency. AOV is stable. So again, the main limiting factor is the underspend. So from here, it'll start to give an indication of some of those supporting data metrics, how they're performing. And then from here, what everyone wants to get to is your suggested next steps. Practically, what are the individual components here that you should do in order to correct that? So ultimately, because the main kind of insight here was underspending, the new customer agent is now going to give you suggestions on how to increase that spend. And again, depending on the goal, it'll give relevant suggestions. So it'll suggest particular campaigns that are performing well over the previous period that you should expect to double down and spend. It'll also indicate, okay, is there any specific campaigns in which you should pull back and ultimately not necessarily spend as much, and ultimately, maybe put that spend to better use in another category. And then from there as well, of course, you can continue to monitor that spend as you make those changes. So ultimately, there's so many variables happening there. You obviously want to double check any of these insights. And we've done a ton of work over the last, really what we're trying to do is kind of procedurally kind of organize the insights, the analysis that we've done with hundreds of brands We've seen the kind of trends, seen what the kind of consistent patterns are, and what are the levers we have to solve different problems. So ultimately, the benefit here is when it's in your dashboard, you can not only kind of jump in from one screen, see how your overall kind of performance is working with your spend advisor, see where you're on track and off track with your acquisition metrics, but then actually start to take action on this data within the account itself. So really exciting one. We're delighted to have a working version of this from a lot of kind of prototypes and a lot of testing over the last couple of months, with kind of a great kind of volume of work done by our team as well in the background. So yeah, I suppose that's a bit of a sneak peek. So I suppose from practically, what I would recommend is, again, goals are ready to go, all easily accessible within the platform today. If you don't have them and maybe you're a legacy customer, it's not appearing within your settings, just let us know and we'd be happy to. My light's gone off. I have to jump around here a little bit to trigger it again. Feel free to give us a shout to get goals and forecasting set up. But also as well, if you're interested in getting signed up and getting access to these insights, yeah, do let us know as well. I'll be excited to try it out. If you're willing to become a guinea pig for a couple of weeks. So yeah, anything to add, Thomas, before we sign off?
No, good to get on. We were looking forward to this one for a while, and yeah, nice to be able to show it off. And yeah, looking forward to getting it live in a few more stores.
Definitely. We've one coming up over the next couple of weeks, between events, between webinars, between different things where we're hosting with different partners, whether it's the likes of webinars with Leading Social around Black Friday, Cyber Monday. You can imagine we're talking about that already. It's June is going to have that webinar in there. We're going to have a ton of other stuff coming up now, between kind of events and a ton there to even kind of start to mention some, and I'll forget others. So feel free to kind of watch our LinkedIn to keep on tabs on that kind of stuff as we go. Yeah, thanks again for everyone watching and maybe tuning in to the playback. Any questions, let us know. And yeah, see you on the next one.